Welcome. This is Ash, your San Ramon and East Bay realtor, and joining me today is Annie from Wells Fargo. She's going to be helping us bust some lending myths. How are you doing today, Annie?
Hi, Ash. Good afternoon. Thank you for inviting. And I'm ready whenever you are.
Okay, perfect. So, the first myth, a very common misconception on credit scores, that there is an ideal credit score that a buyer or a borrower should have so they can get approved for a loan.
Well, credit scores, of course, that will impact the interest rates, okay? Because interest rates, one of the factors that impact the interest rate is the credit score. But when underwriters review file for approval, the credit score itself, okay, is not the whole thing that the underwriter is looking for. Also, the credit report history, and such as trade lines, how many trade line active and closed, and also are there any derogatory credits, late payment, collections, etc. And
Okay.
so, go ahead.
So if somebody has a less than ideal credit score, how does whether you as a lender or Wells Fargo, what are their options? What should they be doing? Because there are so many different advertisements we see where people are invited to go to the credit people who help fix credits. Should we should people go to them first? Should they come talk to you first?
Definitely direct the buyers to us, and then let's discuss like what is making their credit score low, right? And then also different loan programs require different credit scores. Like for example, conforming loan, the minimum credit score requirement is 620, where the jumbo loan financing for fixed rate options, the minimum credit score is 700, and then for adjustable rate mortgages, it is 720. Okay, and sometimes even clients are not meeting the minimum credit score. We can
Mhm.
still ask for an exception and have the exception underwriter review the whole profile and see if we can approve the loan with the score below the guideline. I give you an example. Okay, often like in the IT industry, some buyers moving from overseas to USA and
Mhm.
have the job in USA, and often those type of clients have very limited credit history, or the credit scores are not meeting the minimum guideline. Okay, in this situation, okay, the exception underwriter can review the overall risk profile, okay, and take a look at the current debt to income ratio, how much asset does the client have after closing, and how is the employment history look like, and overall, in the underwriter can make some judgments, and still can approve the loan below the with the credit score below the guideline.
Okay, this is fantastic. So, for people who are new in this country, but like you said, that do meet the other criteria, but might not have a high credit score, not for any fault of their own, but because they just haven't had enough transactions to help
Correct.
them build that history, there's a system in place to help them too.
Correct. And the another route that we can do is international credit that we can pull, right? If they have credit history in their own country, and then
Mhm.
Wells Fargo can do an international credit. But usually, if it's not needed, then we don't really want to go to that route because it takes some time, and then also we don't know the credit history over there, right? So that will create some uncertainties. And if the underwriters can make the approval, like approve the loan without using international credit, that would be great.
Okay, that's wonderful. So, one other thing that comes up, and it brings me to my next point and the myth, because many clients who are also new in this country, and especially I'm also a seniors real estate specialist, so my goal is to always protect my senior clients. The last time they purchased a home was maybe 30, 40 years back. So now when they're in the market, essentially being a first-time home seller, and they are reviewing offers, and they have an offer that has a qualified letter versus a pre-approved letter versus a loan that is fully underwritten. Can you elaborate a little bit more? Because the first-time home buyers also have a misconception of, oh, I have a pre-qualification, I spoke with somebody, I should be able to get a home.
I see. Well, because I work for Wells Fargo, then this is how Wells Fargo identify each, the each type. For pre-qualification, pretty much that is just a verbal, okay, verification of income, assets, and without putting not even a soft credit history, okay, or a soft credit score, the system generate those pre-qual letters, okay. Versus a pre-approval, the borrower, after a consultation stage, usually when the clients are ready to fill out the application, inputting their employment, where do they live, and how much asset they have, and submit it back to us, and with a soft credit pull, okay, then the Wells Fargo will generate the pre-approval letter, okay, and we have a more advanced credit underwriting process, okay, for buyers are ready to make the offer, ready to buy the home within, the next 3 to 4 months or 3 to 6 months, okay. That is with the underwriter review, okay, reviewing the income. Underwriter has checked their assets, credit profile, pull the hard credit report, because it is well, the underwriter will not be able to issue any loan approval without a full credit report. Okay, so it will be a hard pull for credit underwriting process. And recently, Wells Fargo offers soft credit pull, okay, for pre-approval stage client, when clients are ready to do the pre-approval. But for credit underwriting, it's always a hard pull to allow the underwriter review the full credit profile.
Now, how frequently, so like you said, the 3 to 4 or 3 to 6 month time frame, would you be doing another hard pull on a borrower's credit in the 3 to 6 month time frame? Like, is there a sharp deadline? So if I got mine on Jan 1st, when would be the next time? And if for some reason we're not able to find the right home for my client, when would be the next time you would be doing another credit check? Because I think when it comes to a hard pull, that is a scary part for many people. They worry that it's going to take a hit on their credit history. And if they have to do another one, it's going to impact them.
Good questions, right? Credit report, it's good for 4 months. So the credit approval, it's only good for 4 months. But let's say if the clients are not able to find the right home during this 4 months, and they are still actively in the market to buy, and they still would like to renew this process, and we do require another hard check, okay? And they also have to provide the updated bank statement, updated paycheck for renewal. But it doesn't, we do not have to submit a brand new application and restart everything. So that makes the process a little bit better, okay?
Right.
But if the clients are looking to buy a home, and they have not found a home yet, it is always a good idea to not open any new credits, like such as credit cards, car loans, if it's not needed, or make sure there's no collection or late payments, okay? Because let's say if I pull a hard pull today, and if there's no derogatory credit or no late payment, no new credit or closed credit during this 4 months, by the time they need to renew the credit history after 4 months, it should not be impacting the client's credit score negatively. Even a few point drop, okay, but it should not be significant, and usually it goes back up quickly.
Okay. So essentially, when they're in this process, the ideal thing would be for them to stay connected with you if they do plan to have any kind of like you said, making a purchase or anything like that, to run it by you first to make sure that they are not doing anything that would be detrimental to their
Yeah.
situation.
And sometimes, the client needs to have a car, right? Then,
Right.
and they do not want to pay in cash, okay? Then it always have the client call us and then, go through the scenario first, right? Before they do that.
If they have any kind of a red flag, so when you do a hard credit pull and there is some kind of a red flag that comes up, does Wells Fargo provide the support they need to help remove those red flags, or do they get referred out to a different resource? What's the process there?
We always ask the client to call the credit bureaus because those are the agencies that reporting those either error or red flag, not Wells Fargo. So we always let the professions to handle that.
Okay, perfect, perfect. Thank you for bringing clarification on this. Now, is there anything else that Wells Fargo is offering that you want to share that my clients could benefit from? So somebody who is looking into making a move, any unique programs that Wells Fargo has that we should know about?
Yes, Wells Fargo has a big program for the jumbo loan program currently, okay, and we will also apply this program to the conforming loan, okay. This is our asset relationship discount, including down payment will count towards the discount, and we can discuss the details in the next call, and I'll be happy to
Okay,
share that with you.
perfect. Then I look forward to the next call. Everybody, thank you so much for joining us and listening in. Thank you, Annie, for bringing in this valuable information. Do not forget to like, subscribe, and follow my channel so you can get notifications on when we bring Annie back and other people who can help us make better decisions. Thank you again, Annie.
Thank you, Ash. Thank you, everybody.
Take care. Bye.
Take care.